Hi, Tony. Second quarter markets really dominated by tariff uncertainties. What do you think will be the global themes that you expect to be played out in third quarter 2025?
We do think policy is going to continue to be a big issue around the world and especially out of the US. Some of the policy focus will probably shift away from being overly focused just on tariffs. And I think some of it will start to turn more towards things like the tax cut bill and what tax cuts might do for the economy as well. But I think the other big theme that'll be a big focus in the third quarter is just the ripple effects of all this policy. Most economists around the world and we have raised our risks of a recession for the coming periods. And I think everyone's going to be closely monitoring the economic data. Is the economy's slowing around the world and in particular in the US? And is inflation starting to rise and becoming problematic for things like bond yields and the central bank interest rates and all? So I think the shift becomes a little bit more on what the ripple effects in the real economy will be from all that policy that we had last quarter.
Given this, what are the key investment strategies that investors should consider in the coming quarter?
Yeah, so one of the big effects of all this policy and all the changes we had last quarter is that the economic scenarios that are realistic probabilities now have really become quite wide. But as we invest in this type of environment where there's really many scenarios that this economic cycle can go from here, what we're recommending is that we should be a lot more diversified than we have been. At the start of the year, we were kind of really sort of optimistic about growth and really sort of leaning into growth assets. Now, what we recommend is just a broader diversification in all your asset classes, a better balance between growth assets and safe assets. And then even within those asset classes, so for example, in the safe assets and the safe havens, historically, we would recommend just going to U.S. Treasuries, buy U.S. 10-year bonds is always a great place to be when uncertainties are rising. But now what we're saying is to be more diversified, have some U.S. Treasuries, but have some German bonds, have some gold, have some tips, have some short duration and long duration, and kind of be more spread out on your safe asset classes. And likewise in the growth asset classes, we're not saying completely get away from them. It could be we're surprised by growth, but nevertheless, in the growth assets, we've kind of been leading into the U.S. in recent years. And now what we're saying is be more diversified. And if anything, we're leaning more towards Europe and towards Asia and China than we have been in the past.
Tony, we are overweight China and European equities. Can you elaborate on this further a little bit more? And why do you think there's potential for these markets to outperform in the next few months?
Yeah, so we continue to like the outlook for Europe and China that actually have been performing well so far year to date. So in particular, what we would highlight for both of those regions is that in 2024, they were quite weak and that they were already on a trajectory of sort of rebounding into 2025. Additionally, both Europe and China are getting a lot of policy support to help make sure that rebound is on track. And then I think the other part is as the U.S. has implemented all these policies that have made it a more questionable place to invest for a lot of global investors, that I think both Europe and Asia and China are starting to benefit from global investors wanting to be a little bit more diversified in their equities around the world.
World markets have recently become a lot more diverse about high level of debt in U.S. and global markets. Is this something that investors should be really, really concerned about?
Yeah, at the start of the year, we were all talking a lot about interest rate cuts, that the inflation trends that were so problematic after COVID really were making a lot of progress, and that we were expecting central banks really across the world to be focused on cutting rates. And now that's changed a bit. So the tariff policies inject a little bit more inflation risk. And we're forecasting that inflation that looked like it was heading towards 2% probably starts climbing back above 3% and towards 4% by the end of the year. And therefore, that puts pressure on central banks not to cut interest rates as much as expected. and also puts pressure on yields to have sort of upward risk in a more inflationary world. Additionally, part of the policies that we're expecting in the U.S. is to result in some tax cuts, which raises the deficits and therefore creates a little bit more anxiety, more issuances of government bonds, and therefore will put a little bit more pricing pressure, which results in those bond yields going up higher than we were originally thinking at the start of the year. Nevertheless, our view is that a reasonable range for bond yields, for example, for the U.S. 10-year Treasury, is still around 4.25 to 4.75. But with all these policies, we do highlight there's a little bit more risk that these bond yields could push to 5%. But in the end, we still think one of the attractive stories about fixed income in general is that this isn't like the prior decade where interest rates and bond yields were extremely low and really didn't offer any return.
The US dollar seems to be on the weakening trend against major currencies. Is it fair to say that this is a trend that will continue?
When the U.S. has bought lots of goods and therefore have had a trade deficit, other countries have had U.S. dollars and they've invested in the U.S. They've invested in U.S. treasuries and they invested in U.S. equities and the Magnificent Seven and all. But as they close the trade deficit, that means others won't have as much U.S. dollars. They won't be buying these treasuries and U.S. equities like they had. And therefore, I think one of the dynamics of all of this policy uncertainty is that I think that the focus on holding these U.S. dollars has gone down. And I think, especially with like even central banks around the world, they're, I think, much keener on making sure their foreign reserves are more balanced from just having U.S. dollars and U.S. treasuries like they would have had historically. So I think there's a number of ripple effects from all these policies, and one of them is a change in the way countries will be investing in the U.S., and that's resulting in a weaker dollar than we've seen in the past.
Thanks, Tony. So what does this mean for the Asian markets?
Yes, so we do think that makes global markets, and in particular Asian markets, more attractive when their currencies are strengthening versus the US dollar. Historically, in particular, Asian markets have always done better when the US dollar has been on a weakening trend versus Asian currencies. And I think there's a broader implication that when other countries are seeing stronger spending power as their currencies are rising, that helps, especially a lot of the domestic consumer stories and the stocks and the companies that they invest in can do better in this type of environment. So I do think the weaker U.S. dollar does open up opportunities to seek in other investments around the world.
All right, thanks, Tony. Really interesting year to date, and excited to see where the opportunities are in third quarter, and we'll catch up again in the fourth quarter. Yeah.
Thanks.